So we discussed the basics. I told you what central bank is all about, what they do. They intervene in the market, right? They control the activities of the market. That is what they do. They influence the market. If the market is going the wrong side or the wrong way, they control, they make sure everything is in moderation. So we discussed the individuals, investor, what they do. They are retail traders. These are you know you are a retail trader. We all trade in the market, right? Those are retail traders. And I told you why you trade forex. Everyone said they want to make money, and I told you there is no barrier right here. There is money right here. Liquidity, there is leverage. You can trade the forex market 24 5 hours market condition. Low transaction costs and no commission fee. Even though if you are going to pay the commission is less, few when compared to the profits or the amount of trade or the quantity of order you execute in the market. And I give examples like, for instance, let's take for instance, you would like to initiate like a $100 trading trade, maybe $100, and your broker said, okay, our commission fee is going to be like 10 cents. When you compare the 10 cents to $100, you will see the commission is so small, right? This like a 0 point, is that 0 point, I think that should be 0.1%. So that is less when compared to the amount of orders you can execute in commission based on the commission references, right? Now we move on to I told you the next stage is the forex trading session, and that was where we put an end to the class, the last class. Now today we are going to proceed forward from the forex trading session. Forex trading session is open 24 hours 5 days in the week. 24 hours means it operates from morning till night for 5 good days. That means the market will keep on operating, or the operation is on for good 5 days. The market won't split, it won't stop, right? But that doesn't mean you as a trader you have to keep on trading for that 24 hours. Of course, you have to go to bed, relax, take a break, eat, have enough sleep, have time with your family, right? Now, when you get off the market, there are some other people who are going to do what? Who are actually going to continue the trading activity from where you left it, right? Now, this is where we are going to talk about the forex trading sessions in forex. Now, we have the Greenwich Meridian time. So we start from the 21 time frame, 21 all the way to 20. So by the time we calculate from right here, 21, this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24. This is together 24 hours time. So we have 24 hours, 5 days in a week. And the forex market is divided into 4 trading sessions. Now let's count each trading section right here. We have 1, 2, 3, 4, 5, 6, 7, 8, 9. Can see that? So the Sydney section, they operate in the market for 9 good hours. Now it means if you are a trader, excuse me, it means if you are a trader in the forex market and you live in Australia, because Sydney is a city in Australia, that means you are going to trade for 9 good hours from 21 till 5. So 21, that is around 9 p.m. Nigerian time right here, right? So it means if you want to trade the forex market as a trader from West Africa, and you want to trade the Asian section or you want to trade the Sydney section, you have to get ready by 9 p.m. and you trade till 5 a.m. in the morning. So this means, let's say for instance you have you work in the bank or you work in an organization or you work for someone, and then you are always busy during the day and you don't have time to trade. It means you can trade the Asian section. So we call the Sydney section Asian section or Sydney section. So probably you have stumbled on one of my videos on my TikTok or Facebook or Instagram videos. You see in most of my videos I have clock, the three clocks, three trading sessions. That means I monitor the Sydney session together with the Tokyo section and the London section and New section. So in some trading books, you are going to just have three trading sections. Why in some trading books you're going to have four trading sections. So in some trading books you have Sydney, Sydney, right? And why some you have Tokyo, Tokyo, right? No, this Sydney is not correct. I think okay, let me just get it right here. Let's just get it right here. So we have it right here. Sydney. I think I'm right. Sydney, right? We have London and we have those we call the New Yorkers, right? Now, in some trading books or in some trading community, some trader will call these two as Asian section, and I will show you why some prefer to call it Asian section. Why this is the London section and this is the US section. US section. Why some we call the London section the European section. European section, right? European section. Now, most traders treat the Sydney and Tokyo as one section altogether, and the London section as a separate section, and the New York section as a separate section. Now you understand that? Now, we Nigerians, we fall into the London European section, right? While the Americans, the Canadians, the Canadas, they fall into this. And the Australian, the Asian, the Chinese, they fall into this. Now let's get back to our file. Now you can see the differences between the Sydney and the Tokyo is just 2 hours difference. Now from right here we are going to see, from right here we have 21 and there are 22, so this is just 2 hours difference. So it means the Sydney's, the Australian will start the market before the Tokyos or the Japans, so just 2 hours differences. And once they start before the Tokyo, they get out of the market before the Tokyo. So by the time they close by 5, the Tokyo will close by 7. So they will be 2 hours ahead or late. So this is why some traders prefer to just categorize this into just one section. You see that now? Now, the differences between the Sydney and the Tokyo is just 2 hours intervals or 2 hours time, right? Now, the differences between the Sydney and Tokyo is a long time. So from right here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 hours difference, Sydney between London, and there was Tokyo is 12, like 12 hours, or okay, that was overlapping right there. Now, let's check out the differences between the Londoners and the New Yorkers. We have 1, 2, 3, 4, 5. You can see that. So the London gets into the market 4 hours later, the New York gets in, and the New York move the market for additional 5 hours before they get out. So this is why some traders prefer to just have London as a separate section, New York as a separate section, and Sydney and Tokyo together as one section, because the differences in time right is just 2 hours difference, right? So that is the reason some traders categorize this as Asian section, and that's why you see on my billboard or my videos I only have the Sydney section. So I use the Sydney section to track the Tokyo sections as well, but generally we have 4 trading sessions, but you can categorize it into 3 trading sessions. Is that clear, Mrs. Folake?
Yes,
All right.
yes.
Now we move forward. We now dive into the next section. So before we move forward, the Asians, once they finish, the Londoners take it up. When the Londoners finish by 15, the New Yorkers take place. Now, once the New York or the Sydney's and Tokyo, they take over by 9, in I think in 2 hours now from now, maybe 1 hour 30 minutes, the Sydneys, they will take over, they will open the market and continue where the market stop. So currently right now, I have a question to ask you, Mrs. Falake. Who are the sessions currently active in the market by now? Which of the session?
Um, New York.
All right, thank you. That is good. That is good. The New Yorkers are active because 20 right here means 8 p.m. So they are still active, and this is 7 right now.
Yeah.
So they are still active. They are still the New Yorkers. They are still active right here. So it means if you are a trader, if you trade the London session, you should get out of London market by 3 p.m. You can see that 3 p.m. So if you are American, if you trade the American session, you get out by what? By 8 p.m. you should be out. So in the next 30 minutes from now, the Americans are going to wrap up things, get out of the market, and the Australians, they will be prepared to take over the market. Now, you can see there are some times whereby the Londons and the New York overlap. Right here is overlapping. You can see the overlapping right here. So within the 12, 13, 14, 15, there's always liquidity between this zone. Do you know why there's liquidity? Because people trading in the London session brought or bring a lot of money from the European section. Now, people in the Americans as well bring their own money. Now, when you add these two money together, the money become bigger, and that's what we call liquidity will increase. That's what we call overlapping in trading. So whenever there is overlapping, there's a higher tendency for traders to make fast money, quick money, because two sessions are involved. It's just like two sessions, it's just like two countries bringing together financial resources to work on a project. So that is the meaning. Now, during the Sydney and the Tokyo session, when they overlap, market will move during that session. You can see that. Now, during this overlapping of time, there are some currencies you trader need to look out to trade. Yes, during this overlapping of time. For example, right here, when the market overlaps at this level right here, and they're overlapping at this level right here, there are some currencies you have to trade as a trader. For example, right here, if you are trading the Great Britain pound sterling, which is the currency spent in London, if you paired it with the New Yorkers or the American currency, which is the British pound sterling paired against the USD, GBP paired against USD slash USD, you tend to make fast money within these 12 p.m., 1 p.m., 2 p.m., 3 p.m. You tend to make more money. So if you are that trader who wants to trade and make fast money, one of the currencies you'll be trading within this time frame is the British pound sterling paired against the USD. You tend to make fast money. Now, if you are that trader that likes to trade at night, maybe you are in West Africa, you are in Nigeria, you are in Ghana, Cameroon, or any West African countries, and you are not available to trade during the day, maybe you want to trade at night, that means you have to be prepared. Maybe when you get back from work by 5 p.m. or by 6 p.m, you cook, after you are done with your dinner, you have to take some rest. After your rest, you can wake up by 11 p.m, yes, and start trading the Sydney and Tokyo session. So during this time, one of the currency pairs you can trade is Australian dollar, because the Australian dollar is the currency you spend in Sydney, that is in Australia, then slash the currency you spend in Tokyo. Ms. Falake, do you know the currency you spend in Tokyo, Japan? Do you know it?
JPY.
JPY, thank you. So when you pair the AUD paired against the JPY, you tend to make fast money because these currencies are active during this time and you are trading them because they are active. So we are capitalizing on the trading session. So you tend to make fast money. Another good example is when you pair the New Zealand paired against the JPY, you tend to make fast money because the New Zealand also have the same time frame with Australians. So that is it. And during this London session as well, you compare the euro against the USD because euro also belongs to the European section. Remember, London is also under the European section. So you pair euro USD, you make money. Right? Good. So that is it. So that is how you use these time frames for trading sessions to trade. And during the New York session, you can trade currencies paired against the USD. But one of the currencies that can make you fast money is USD paired against the Canadian dollar. Do you know why USD paired against the Canadian dollar can make you fast money? Because US and Canada, they are in the same time zones. So it means the currencies are both active during this time, right? So when you trade this currency, you make more money, right? Now, that is how you use the Forex trading sections. So for now, you are here to understand currency pairs. Do not worry, we are still going to talk about that in the later section of our tutorial. So for now, just know what trading session is all about in Forex trading, right? Now, let's move forward. Now we go on to terminologies. Terminologies. This is very, very important in trading because these are the terms we are going to communicate in trading. We know there are a lot of professions with different terminologies. For example, we have the engineers, they have terminologies. We have the medical practitioners, they have their own terminologies, right? We have the law, people in the law, they have their own terminologies. So if we would want to speak whereby we don't want the ordinary layman or the public to understand whatever we are saying, there's a way we can present our information by using terminologies in trading. So there are some times, or there are going to be times whereby I'm not going to tell you to buy. I will only tell you I'm in a bullish entry or I'm looking for a bullish entry. So whenever I say I'm bullish, it means I'm buying or people are buying or the market is going up. Now, bullish, bulls or uptrend means that the market is going up. So whenever you hear this word here, bullish, bulls, uptrend, it means the market is going up. Mrs. Falake, can you see that on your chart? Can you see that on your screen?
Yes, I can.
All right. So when you hear bullish, bulls, uptrend, it means the market is going up. So I won't tell you buy. No, I'll just say bullish, bulls, uptrend, the market is going up. That is the meaning. And how can we know the market is going up? Now let's check our charts right here. Now, in this market now, the market is going down. These are some of the trade we took in our community. I think you should see the screenshot of the profit right there. So this is a downtrend market.
Yes,
Now,
yes,
oh, okay, good. Now, let's go for a market that is going up. Example right now, this is a uptrend market, a bullish market. So any blue bar you see on this chart represents buying, and any red color you see on this chart represents selling. However, you can use any color to represent your bars, your candlestick, where I'm still going to show you in the next section of this tutorial. But for now, just know whenever the market is going up, it represents bullish, bulls or uptrend. And whenever the market is coming down, it is what? Bearish, bears or downtrend. Now, are you familiar with the animal kingdom? Do you know the animal called bulls?
yes,
You know the way this animal attack its prey. It always uses its horn to swipe up its prey into the air. So that is where these names were being originated from. So we go to the bulls. When we talk about the bulls right here, let's check the bulls animal. Let me show you so that you can have an example of the bulls. So this name was being gotten from the way this animal attacked its prey. So this animal has horns. It has horns. So whenever it wants to attack its prey, it uses its horns to swipe up that prey into the air. So by the time it lifts this animal or its prey into the air, it means the animals or the prey will be thrown up into the air or up. So that is where the name was being originated as bulls. So whenever you hear bulls, it means the market is going up. Now let's see bears. Bears animal. So the bear is opposite. If the bear wants to appear if it wants to attack its prey, it swap down, it clamp down on its prey. It's clamped down, it swap down on it. So that is why we say, okay, the market is going bearish, the market is bear, the market is in a downtrend. So this is the animal bears. So have you seen this animal before in documentary? Bears? Miss Fala,
yes.
right. So this name was originated from the activities of this animal. So that is why we call it bears, bulls, bears. Good. Now, on our white slide, now that is the meaning. So bears downtrend, bulls uptrend. Now, another name I can use to represent my bullish is long. So when I say long, I do not mean a long stick or a long table. I mean long. Buy. Long means buy. So if you are investor, if you are in the trading community, you hear people saying I'm long on Bitcoin, I'm long on British pound sterling USD, I'm long on Tesla stocks, I'm long on Microsoft stocks. It means they are buying. When you hear short means they are selling. Now let's make references to our Telegram group. In our Telegram group, we sent out a trading signals and we said short. Now when we sent out this trading signal, we said short. Now this is okay. Okay. Let me just go through the well. We said short. Now this is it right here. Wow, a lot of people sent. All right. Now profit. Now this profit are just everywhere. Just big of profits. Okay. Now British pound sterling paid against the Canadian dollar. This trading signal was sent. That was on January 7. You can see asset British pound sterling paid against the Canada. Direction short. So we are telling our students right here that we want to sell. You can see right here we didn't say sell, we said short. So someone who is new to trading, someone who has ever heard about this will say, what is the meaning of short? What is short? Do you mean the nickel is short, or do you mean the man is short? I don't understand. So short means we want to sell, right? And whenever we say, oh, we want a long, like right here, cutting, you can see bias long, we want to what? Long. So that is it, long, right? Now that is it. So we long for buy, we short for sell. Now what is leverage? Leverage is like loans, but this time around is not equivalent to loans, but it has a similarity to loans. When you get loans from the bank or from anyone, mostly you are being required to pay interest on the loans. But in terms of leverage, you won't pay interest. Your broker will give you accessibility to a fund. You can use that to increase your margin. Once you make profit, you withdraw the profit. And once the trade is against you, you have higher chances to lose your capital. And when the trade is in favor of your direction, you have higher chances to make bigger money. So it means most of the time, if you want to open your trading account, you will see some letters, some words like this. You will see 1:10, or let's start from 1:1. So most of the time on your chart, you will see 1:1. You will see 1:10, and you will see 1:100, and then you also see 1:1000. Now 1:1 means your broker is not giving you the opportunity to take loans or to take leverage. So it means if you have $10 on this account of 1:1 leverage, you can only take what? $10 trade. That is the meaning. 1:1 means if you have $10 in your account, you cannot execute position more than $10. Now ratio 1:10 means if you have $10 in your account and you are giving ratio 1:10, it means you can multiply your amount with times 10. That means if you multiply 10 times $10, Miss Falake, that will be what?
100.
So it means you can take a trade of $100 even though if you have $10 in your account. So you are trading on leverage. So if the market should go in your direction, you make bigger money. But if the market should go against you, you lose your money fast. So if you are given a leverage of ratio 1:100 by your broker, it means if you have $10, you can do what? Take a trade of what? 1,000. That will be 10 times 100. And if you have a leverage of 1:1,000 and you have $10 in your account, it means 1,000 times 10. You can take a trade of $10,000. So leverage is a double-edged sword. It is not for beginners traders. It's for experienced traders who are willing to take responsibility for if anything should go wrong. So as a beginner trader, stay off leverage, but it is better for you to know what it means when you are open up your trading account. So that is leverage. Now when we talk about margin, we are talking about money you have in your trading account, the available money in your account. If you have $100 in your account, your available margin is $100. By the time you execute a trade out of your $100, your margin will be reduced because you have taken out some part of money from your capital to trade, so your margin will reduce. So margin is the money you have in your account. Liquidity is money. When you hear liquidity, it means there is money in such market. Remember the description or the explanation I give between Londoners and New Yorkers. I told you whenever their market overlaps, we tend to have money from the London side, money from the New York side coming together. It means there will be bigger money. But in trading, we won't say bigger money. We will talk in terminologies. So we are going to say liquidity. Likewise, in trading, we won't say amount of money I have in my portfolio or the amount of money I have in my trading account. You will say my margin is $100. If there is a lot of people trading the market, you say there is liquidity. Is that clear?
Yes, yes.
Right. Now, when we talk about pips, units of measurement. Now, you know the engineers, they have their own unit of measurement. For example, centimeter is a unit of measurement. Meter is a unit of measurement. Kilometer, unit of measurement. Now, I'm going to ask you some questions in this class. How many meters make 1 kilometer? Miss Folake, how many meters make
Sorry?
how many meters makes 1 kilometer?
It's 1,000. Yes, 1,000.
1000 meters make
1,000.
1 kilometer. Now we have our unit of measurement in trading. Our unit of measurement is pips. So in trading, 10 pipette, 10 pipette makes 1 pip. So this is our unit of measurement. So most of the time, brokers won't take measurement in pipette. They would rather do that in pips. Now let me show you what I mean by that. Now, if you are trading in the market, you're going to see some charts. For example, right now, this is USD paired against the Canadian dollar. Under normal situation, this chart should be, the value should be printed in 4 decimal places. But right now, the market is printed in 5 decimal places. For example, right now, at this level here, this 1.43600. That is what? 1 2 3 4 5. This is 5 decimal places, right? After the dot. So this measurement is in pipette. If the measurement was to be in pip, it would be 1.4360. So whenever you see that a currency is plotted in 4 decimal places, it means the broker is taking measurement in pip. And whenever you see 5 decimal places, the broker is taking measurement in pipette. Do you understand that?
Yes.
Right. But there is an exception to this rule, and that exception is currency paired against JPY. Instead of currencies paired against JPY to have 5 decimal places as pipette, they would rather have what? 4 decimal numbers. That was how JPY was being programmed. Now let's switch to USD yen and see an example. USD yen, what do you have right here? 3 decimal places. You can see that. You can see that. So
Yeah.
there is an exception. Your yen currency pairs, once you see your yen currency pairs, they won't give you 4 decimal places, but instead they will be plotted in 3 decimal places. So those are yen. So any currency against yen, you know, okay, this is yen. It does not follow that rules of 4 decimal for pipette and 4 decimal for pips and 5 decimal for pipette. It will be in 3 decimal places. So that is for yen. So let's check our slide. Now that is unit of measurement, pips. So when I say the market has moved 100 pips, I'm talking based on the value, the distance. Now let's go to the British pound sterling paired against the Canadian dollar, the trade we took right here, we sent to the community. Let's see the distance the market has moved from the trading signals we sent. British pound sterling paired against the Canadian dollar. We made our entry right from this structure right here. This is where we made our entry. You can see that. So from this entry right here all the way down, the market has moved almost 222 pips, but the market has retraced now to what? 177 pips. You can see that. So our first target was this support right here, which is what? 161 pips. We risk
Yeah.
we risk 52 pips for 162 pips. That means we are having times 3 of our risk. You can see that. So it means in this market, if we are willing to risk $50, we are willing to make $150 as profit. So that is
Yes.
risk management. We are still going to teach you this in the later section of our tutorial. But before you can do this, you need to understand what pips is all about and how you can take measurement of pips. Is that clear?
Yes.
Good. Now, back on our chart, we now have bid and ask price. Now, before you can buy an asset in the financial market, someone must be willing to sell and someone must be willing to buy from you, right? So if you bid, it means the amount you are willing to purchase an item, the amount of money you are willing to pay for that item. But the ask price is the amount the seller is willing to sell. Now, let's go through our chart once again. Now, you are going to see this red section right here. This is 1.77854. We have 1.7789. Let me try to see if I can open a trade create mirror. I want you to see that very well. Let's just open a paper account right here so we can use that to demonstrate trade. All right, now we have, I think I want to show you. Oh, this is not showing the bid and the. Okay, let me try to see. I want you to see something very important so that you understand that concept of bid. Okay, let's just quickly get this on Google. Bid. I want to show you the image. Bid and ask price. All right, images. Right, good. Now this is how this image will looks like on your price chart. Let's just use this. Now you can see right here, this is the bid. The bid
Yes.
comes at the left hand side and the right comes and the ask comes from the right hand side. The same thing right here on this price chart.
I can see it.
Yeah, I want to show you another example right here. That
Okay.
was what I was trying to explain. So let's go back to the chart. Now you can see it right here. Now this is the sell, this is the buy. You can see. So this is the differences between these currencies. Let's go back to the image. On this image right here, we have bid, the amount you are willing to buy. That is 15165.80. Ask, you can see. But in trading, when we say bid, the way it is being interchanged in trading is different. Let's go back right here. Let's open our chart so that we can see this. Let's first, for example, right now, right here, bid right here. If you click right here, you sell. Ask right here. If you click right here, you buy. Let's go back to the price chart. You can see bid equals to sell, but under the normal English, bid means, let's say for example a car wants to be sold at 1 million naira. You now bid the price. Have you gone to any auction or site or any auction
Yes.
or sales whereby an item will start from a low price and people will start bidding
Yes.
the price up? Yes, that is
Yes.
a better example. So people will start bidding it up. Now you can see right here now, this 15165.80, this 15166.30. The ask price is greater than the bid price. The seller is willing to sell. Let's say for example, the seller is willing to sell for 1 million naira, and people are now bidding for 800,000 naira, and that will be a countdown time. So whosoever bid it higher before the countdown period will win the bidding. So, but in trading, the ask price will be higher than the bidding price. Because, for example, if an item is being sold for 1 million naira, under normal condition, you want to do what? To purchase it at a lower price.
Yeah.
This is it right here. Price at which the buyer is willing to buy. As a buyer, you want to purchase it at a lower price. But the seller is doing what? Is willing to sell at a higher price. Because as a seller, you are willing to make more money on your item. But as a buyer, you are looking for a way to what? To reduce the price so that you can buy it at a better, cheaper price. So that is the concept of bidding and asking. So whenever you see this on your price chart, don't be confused that, oh, what is the meaning of this? No, that is the meaning. Right, sell, buy. Okay, let's go back. Now, that is the meaning right here. So the differences between the bidding and the ask price is what we call the spread. Now, let's say, for example, again, let's go back to our chart. Now you see right here, we have the bid at the left hand side and the ask at the right hand side. Now, if you subtract 151.65.80 minus 1516630, there's going to be a difference. Now, the differences between this bid and ask price is what we call the spread. So whenever you hear spread, spread is the differences between the bid and the ask price. So who takes this money? Your broker takes this money. Is that clear?
Yes.
Now, we have stop loss and take profit. Now, on the trade we took on British pound sterling paired against the Canadian dollar, I showed you where we got our entry. So,
Sorry, I have a question.
ask your question.
Since we have a sell price of 1.7785 and then a buy of 1.778. So this row or this indicator that is moving up and down that has GBP card.
Yes.
No, down.
Yes.
You know this?
Yes,
Yes.
yes.
So what is that one?
Okay, this is showing you the current market price. It means currently right now, the exchange rate, if you would like to purchase one British pound sterling currently right now with Canadian dollar, you have to pay 1.7 Canadian dollar, 1.7 Canadian dollar to buy one British pound sterling. Don't worry, let me show you an example you can easily understand. Let's go to the USD Naira. I think that would be a good example for us to understand. Now, let's check it out. This is Naira. Let's check it right here. Okay, let me use this my chart here. Now, let's check for Naira. USD comes first as the base, and we have NGN. The first currency you see at the left hand side is the base, and the last currency is the quote. So you use the quote to buy the base. Is that clear? Don't worry, I will still show you more details. Now on this price chart, what can you see right now on this USD paired against Naira? It means we have 1,532 Naira 61 kobo. If you would like to purchase $1 with Naira, you need 1,532 Naira and 61 kobo. Is that clear now?
Yes.
Now, this blue color is showing you the current exchange rate of dollar to Naira. Is that clear?
Yes.
So that is so you have the first currency at the left, USD. So the USD is what we call the base. Base. So when we say base currency, the first currency is the base. Now we have slash NGN. Now NGN is what we call the quote. Quote or counter currency. Quote or counter currency. So you can hear counter or you hear quote currency. So whenever you hear this, don't be frightened. It means counter. So you use the what? You use the quote or counter to purchase the base. So if the Naira is the counter, it means if you would like to purchase the USD, you have to get 1,532 naira. You can as well use the base to purchase the counter. But if you want to do this, you have to exchange it. But do not worry, we are still going to talk about this in later classes. So I don't want you to be confused right now. Right? So that is it. Right? Now, back to our price chart. We have the current market price of British pound sterling paid against the Canada as 1.778283. So it means, as a trader, if you would like to purchase British pound sterling with Canada, you need to make a deposit of $1 and 0.783. So you can approximate it to be 1.78 Canadian dollar. So for you to buy one British pound sterling as a Canadian or traveling from Canada to London, you need 1.78. So that means if you would like to purchase 1 million pound sterling currency, you would need what, Mrs. Falake? If you are willing to purchase 1 million pound sterling with Canadian dollar, how many Canadian dollar currencies do you need? You just multiplied
Yeah.
it by 1 million. So that is
Yes, I'm going to put.
1.78 million Canadian dollars to get 1 million Great Britain pound sterling. That is it. Now, so simple as that. So now you're gonna see right here, we have our entry at 1.79658 right here. We had our stop loss here, and we have our first take profit here. So stop loss is a level whereby if the market doesn't go in the way we have forecasted or we projected, we lose when the market hits this stop loss. Let's say, for example, we place it to be $50. So if the market doesn't go the way we have projected, if the market should go up and hit this level, we are out in $50 minus from our account. And the market should go downward from our entry based on the risk to reward ratio we have set right here. Then that means I'm trying to I'm just trying to. All right, so let's say, for example, from our entry here, entry TP. TP means take profit. So whenever you see TP, is take profit. LCL means stop loss. Take profit. Take profit. So that is the abbreviation. SL means stop. Stop my loss from getting bigger than I can take. So when you see ENT, that is entry. So TP is where you want to get out if the market should move in your direction, and stop loss is where you want to get out if the market should move against you. So if you're having your TP above and you're having your stop loss below and you're having your entry above, it means you are looking for what? For buy. And if you're having your stop loss above and your TP below and your entry below your stop loss, means for lack, what are you doing? What are you looking at to do in such a trade?
So,
You are looking to sell. So if your TP is below, you are looking for a sell, and if your TP is above, you are looking for a buy. Because for your TP to be achieved, the market has to gravitate or move in direction of your TP. So that is what TP stop loss is all about. Now, lot size, swap, base and quote. What is lot size? Lot size is the amount or the quantity of order you want to purchase. You want to buy, you want to sell in the market, you need lot size. Now you can see right here, we have 50.00. Now this trader right now on this account is trying to trade what? 50 lot size position. So this is where you put your lot size. On this our trading platform right here, we have the trading view, and right here we right click. We are still going to show you how to use this platform, but this is just a beginner's class. Click on this, and right here I can input units. So these are my lot size units. You can see that as I keep on increasing my units, the amount keeps on increasing in value. So position, lot size is the quantity of order you want to buy or you want to sell, right? Good.
Yeah.
Now we have swap and base. Now what is swap? Now let's go back to our community. Now some trading signal was sent, that I think that was on 7th. On 7th was yesterday, right? The order was being sent that sell British pounds sterling Canada. Those who shorted sold the currency from January of 7th and are still in the trade right now. The broker they use would have what? The broker would have charged them swap. Now swap is a fee you pay for keeping a trade overnight. Now how can you know overnight? Whenever the market close, you will be charged swap. Now remember in the beginning of the trading course I told you forex trading operates 24 hours 5 days in a week. Now the forex market starts either by 10 p.m. or by 11 p.m. Sunday evening. So there is a time we have time changes whereby the time we move addition +1 forward or -1 backward. So in a situation whereby the market moves forward, we have 11 p.m. The market will open by 11 p.m. and rotate from that 11 p.m. all the way to the next 11 p.m. So if the market should open by 10 p.m. or by 11 p.m. on Sunday evening, it has to operate from that time to what? To another 11 p.m. or 10 p.m. on Monday evening to make it a 1 day operation. So after that 1 day has been completed, the market will open for another day. So whenever you leave your position and the clock tick 10 p.m. for another opening market day, you have to pay swap. That is charges you pay for keeping your trade overnight. Overnight means the market has met or meet your position till 10 p.m. and open another trading activity for another day. So it's a swap. The price or the cost or the charges you have to pay your broker for keeping your trade more than the 12 hours tick or clock. Alright, and that
Yeah.
doesn't mean you have to keep your trade for 24 hours. Let's say for instance the market want to close by 10 p.m. and you now open your trade by 9:59 p.m. Once 10 p.m. clocks, you will pay that swap. Why? Because your trade was on or is on till that 10 p.m. So that is why some trader before they take a trade, if they are swing trader, they want to avoid swap. Let's say for example right now I can see a good trade setup in the market and I see that the market is almost coming to like 10 p.m. See that I can wait for the market to tick so that I can avoid swap. But that
Yes.
doesn't mean you have to wait. When you compare the amount of money you pay in terms of swap, it is very small when compared to your position size. But on some fraudulent broker, the swap can be too much. So this is why we do recommend our broker so that you can trade on a reliable, transparent, honest broker. Let's say for example, if you should open a $100 trade size on your account, if you are keeping your trade overnight, your broker shouldn't charge you more than 0.10 cents. If your broker is charging you up to $1, then such broker is charging a high swap fee. Likewise, your commission, your spread shouldn't be too wide. So if you are trading on this such broker, it means you are eating deep into your margin or your portfolio or your funds. So to avoid that, trade on our recommended broker. Link down below in the description of this video, or I will send you the link after this class. Right? Also, you have a link to the recorded version of this class after this class, so you can watch the video again. Right? Now, finally, we have the base and codes. I already explained this. So Mrs. Folake, Can you tell me what is base, or can you give me an example of base and quote?
Okay. So if you have, for example, GBP USD,
Right.
the base currency is the Great British Pound,
Thank you.
and the quote currency is US dollar.
That is right. It means you understood everything we discussed. That is right. So we are done with this section. So we move on to the next section. So we have currency pairs. Currency pairs, we already did that. So you said GBP paired against USD. That is currency pair. Now there are series of currency pairs. We have minor currency pairs, major currency pairs, and exotic currency pairs. When something is major, major means the most traded currency pairs in that market. So when something means major, it means the currency that leads the market most of the time. Now, for us to understand major currency pairs, we need to know that there are 8 major currencies in the world. US dollar is the world reserve currency. Euro, Canada, Switch, New Zealand, AUD, Great Britain pound sterling, and JPY. Now, once any of these currencies are paired against USD, we have major currency pairs. Now, Euro, Canada, Switch, New Zealand, AUD, GBP, JPY, whenever they are paired against USD, they give us what? Major currency pairs. For example, British pound sterling paired against USD is what? Major. Euro paired against USD is major. Switch paired against USD is major. New Zealand paired against USD is major. AUD paired against USD is major. JPY paired against USD is major currency pairs. Major currency pairs are the top leading economy in the world. Do you understand that?
Yes.
Now, we move on to the minor currency pairs. Minor currency pairs. Minor currency pairs. So these are the 4 major currency pairs, but these are the 8 major currencies. Don't get it mixed up. 8 major currencies are different from pairs. We list the 8 major currency pairs. Now we pair them against one another. When we pair them against one another, you cannot pair USD paired against USD. It is wrong. If you paired USD paired against the USD, it means you want to use USD to buy USD. Can you use Naira to buy Naira?
No.
But that was an exception. Don't forget, during this cashless policy, whereby you have to use your money to buy what? Do you remember that time in Nigeria during the cash policy?
Yeah.
So Nigeria is a unique country, right? But under normal forex operation, you can't use one currency to buy the same currency. So that is why we cannot
Yes.
pair USD paired against USD. Instead, we have to pair it against another currency, right? Good. Now let's move forward. So we have 8 major currencies and we have 7 major currency pairs. Now we move forward. Now we have minor currency pairs. Remember, we have 8 major currencies. Now, what happens when we pair GBP against Euro? You know, we didn't pair it against USD. Instead, we paired against another major currency pair. So, whenever we pair currencies against one another, excluding the USD, they are called what? Minor currency pairs. Minor currency pairs. So example is Euro GBP, New Zealand yen, Canada Swiss, right? So they tend to have less liquidity, and major currency pairs tend to have high liquidity. What is liquidity, Mrs. Falake?
Liquidity is how much cash, cash, yeah, cash that you have.
Yeah, so liquidity in the
Quick.
market means, is there a lot of money? When you hear there's high liquidity, it means there's high money in that market. When we hear there's less liquidity, it means there's low volume of money in that market. So any currency paired against USD tend to have high liquidity because USD is a world reserve currency, and when something is world reserve currency, it means most of the transaction around the world is done in USD. So when you pair any currency against that USD, they tend to have high volume of transaction. That is why major currency is one of the best currencies to trade, to make fast money, easy money, and it's easier to analyze. And that is why we do advise beginners to stick to major currency pair. Now, my question, Mrs. Folake, the trade we shorted on British pound sterling paired against the Canada, What type of currency pair is it?
Sorry, which one?
The trade we took on British pound sterling paired against the Canadian dollars in our community. This trade right here, what currency
Minor.
pairs? Thank you. It is minor currency pairs, right? Now,
Yeah.
there is now some exception. There are some currency which are called exotic. Example, USD paired against the naira. The reason why USD paired against the naira is exotic is because the naira falls under the underdeveloping nation. So there are three categories of nations of development. Now, there are three ways to categorize the development of a country. We have developed country, we have underdeveloped, okay, no, after develop we have developing, sorry. We have
Mm-hmm.
developing, and we have underdeveloping.
Develop.
So, Mrs. Folake, what is the meaning of developing?
Developing countries that still have room to grow.
Okay. When something is developed, it means the country has developed. They have all the latest technology.
Yes.
Other things coming in are just additional. When
Yes.
something is developing, it means they are growing at a faster speed. They are getting better every day. And when something is underdeveloped, they are still in the struggling stage. They are still struggling. So when currencies underdeveloped nations are paired against underdeveloping, they are called exotic.
Exo
So give me examples of developed nations, Mrs. Falake.
USA.
Thank you. Great Britain pound sterling, London, right? We have euro,
Mm-hmm.
we have Austrian dollar, we have New Zealand. Thank you. Now, developing nations, examples.
Um, Maybe Egypt,
Or okay. Singapore,
Nigeria, all of
Singapore,
yeah,
Taiwan, most,
India.
yeah, most those Asian countries, right?
Yes.
So thank you. So this is where we stop today. So those are exotic
Okay.
currency pairs. Naira is under the underdeveloped. So any currency paired against USD which is underdeveloping or developing nation are called exotic. They are called exotic because they have less liquidity, because most of the market participants are not interested in such currencies because they have little economic activity, right? So in the next class we walk into mini lot, micro lot sizes and numbers of lot sizes, right? So do you have question before we put an end to the class?
No, no.
All right,
Thank you
thank
very
you.
much.
I'll see you in the next one. Peace. After this class you get a copy of this
All
class.
right.
All right.